We're wrapping up the week on Question Time here at Alhambra Investments, and Steve Brennan has got the lead in for today.
Sure. We're doing our recap of the week, where we're at with DARP, dollar and rate paradigm, economy, markets. And in chatting with you, Joe, I'm just going to throw out there also, are we back to maybe good news being bad news? But maybe you can give me an update on the week here.
Okay, so here's the update for the week. Nothing's changed. See you later. See you next week. Well, maybe not quite that simple. When we're talking about the dollar and rates, though, that is the news, and nothing's really changed. We're still where we've been for months, actually almost 2 years, which is rates going sideways and the dollar going sideways. We did get a push down in the dollar last a couple weeks ago, where we got down into the 103s on the dollar index, but we're right back up above 104 this week. Some fairly solid data, economic data here in the United States, and so we've seen the dollar firm up this week. So we're still right back in the same place we've been. 10-year Treasury note rate today we're 4.24. We got down to about 4.15, but we've rebounded again with some decent economic data. So really there's no change. Now, from a market perspective, we did have a good part to the early part of the week. Monday and Tuesday were really good. Wednesday, but Thursday and Friday. Wednesday was kind of a nothing day for us, although I think the market was down. We had some things up, and we ended up, I think, flat on Wednesday. Down a little bit yesterday. Market got hit pretty hard again on Thursday, and getting hit again today. That's part of the correction, in the S&P that we've been looking for. So that's not surprising. On the small cap side, we've seen a little bit of a pullback over the last couple of days, although not in REITs. REITs continue to do quite well. I think they're even up today. But small cap, listen, this is not unusual. You had a small cap move of 11% in 5 days. You're going to get some pullback from that. I guess my message from a market standpoint would be that's normal. You go up 11, you give back 2 or 3. That's pretty normal stuff. But I would say that reversal from large cap to small cap can be, well, put it this way. In the past, it has been a marker of a turning point. And in general, when you see these turning points like that, you see small caps continue to outperform for quite a while. We'll see how that goes this time. It's not carved in stone, obviously, and I think some of the move in small caps may have been a little artificial, and I'll talk about why. So all the economic data for the last month or so, maybe even a little bit longer, has been coming in a little bit less than expected. Expectations for the economy seem to be too high, and we follow what the Citigroup puts out a thing called the Economic Surprise Index, which just looks at each report and says, was it positive or better than expected or worse than expected? And they do a tally, and that number's been negative for a while now. But it only gets negative for a while, or to a certain level, and then it has to kind of recover, because what happens is the analysts out there start to adjust their numbers. They're always behind the curve. These guys think they're supposed to be out there telling us what's going to happen. They have a real hard time with that. So they get too excited when things get good, and they get too depressed when things get bad, and so they always overshoot. But it looks like that this week that turned around. Now, we didn't get a lot of data this week, but I think it was some fairly important data. The only report really that was less than expected for the week was the Empire State Manufacturing Survey. That's the New York Fed area. It was a little bit light, minus 6.6, but overall, if you look at the internals, it wasn't a bad report. The new orders were steady, and there was a comment in there about that the respondents said they were optimistic that things were going to improve. So a minus 6.6 on that report is not great, but it's certainly not terrible. But the rest of the week, everything came in better than expected. We got retail sales, which looked flat, 0%. That was the month-over-month change. But sometimes there's a but. In this case, if you look at it ex autos and ex gas, it was plus 0.8, which was way better than expected. Everybody was expecting up 0.2. And part of that was it was affected by both things, autos and gas. Autos, I don't know if you guys know, but auto dealerships had a huge software outage last month, and it affected their sales because for a while they couldn't process anything. Which is ironic. I'm reporting that today because there's a lot of things not working today because of some problem with CrowdStrike and Microsoft, and I'm not sure what's going on. But anyway, autos were down. You had a kind of an artificial depression there for part of the month on the auto sales. So that's part of it. And gas prices went down too. So if you take out autos and gas, it's up 0.8. That's a good number. And it has been improving. Housing market index was flat, 42. Housing market index is just that's a measure of home builder sentiment. It's been under 50, and 50 is the dividing line. If it's above 50, they're optimistic. If it's below 50, they're a little bit pessimistic. It's 42. Low 40s it's where it's been. And that's just simply because the housing market has not been that great. That's kind of more of a contrarian indicator. When it's low, you got to expect it's going to recover. And we did see that later in the day. We saw, or on Tuesday, we saw housing starts were better than expected, up 3% and change. And building permits were also up. But now I will say, and I've got a report over on my personal CFO.com. I did a kind of an in-depth dive on this housing issue with new homes. One of the things that we're seeing now is that new home inventory is kind of high. In fact, it's at a 14-year high. There's some mitigation there because it's not all fully completed homes ready to move in. Some of them are still under construction, but inventory is high. And that's part of the reason the home builders are kind of depressed, because inventory is high and traffic at the models is not that great. Anyway, it's kind of a deep dive on inventory and stuff over there. Look, I don't think it's as big an issue as it looks like, just simply because there's a low inventory of existing homes. And as mortgage rates come down, that should come up a little bit, but you're going to see demand jump too. We don't know exactly how that's going to come out. But look, existing home sales are running over 1 million below where they normally do, or where the average is since 2000. So, like I said, I don't think it's as complicated as it looks. Mortgage rates come down, you're going to see housing starts, and you're going to see existing home sales go up. And that inventory on the new home side will probably come down. Better news, again, this is something we've been talking about for a couple of years now, about this oscillation between services and goods consumption. Goods consumption was great during the part of COVID where everybody was stuck at home, and they were buying stuff on Amazon and IKEA or Wayfair or whatever. And then everybody was able to get out. So then services spending started to pick up and goods spending dropped off. And now it looks like, and this is something we've been mentioning for a while now, inventories on the goods side of the economy got low. They've been falling. If you look at the inventory to sales ratio at the retail level, that number's pretty low and it's been falling. And we've said they're going to have to restock. They're going to have to restock. It's going to mean more imports, and it's going to mean more manufacturing. And that's indeed what we see with industrial production up 0.6, which was, again, much better than expected. And manufacturing was up 0.4, which was also better than expected. And by the way, these are now up for the last 5 months on industrial production and manufacturing production, up for the last 5 months and 7 of the last 11. So that is moving in the right direction. And then we also got the Philly Fed index. The Philly Fed index is more important than the New York, the Empire State, because it's a bigger area and more manufacturing. And that came in at 13.6, which is a much, much better than expected. And it is up 6 months in a row. Production is picking up. It has to pick up. And so that leads to the question of, let's talk about what the market has done over the last week after that CPI report. We've priced in 3 rate cuts now. Now, not fully. And when we look at the Fed funds futures market, prior to last Thursday, when the CPI report came out, we had 1 rate cut priced in. An over 50% chance of a rate cut was only existent in 1 month, September. And that was about a 75% chance you were going to get a cut in September of a quarter point. If you look at November and December, the odds were well below 50. Well, now we have 3 rate cuts with greater than 50% probability. September's up to in the 90s now, plus 90%. Everybody assumes that September is going to get done. They're looking for a cut in November and December now. So we priced in 3 rate cuts. The problem with that is that I'm not sure that the Fed is going to be all that happy if the economy reaccelerates here. If nominal GDP reaccelerates, I'm not sure how much of it's going to be inflation, how much of it is going to be real growth. But if nominal GDP accelerates here, I'm not sure the Fed is going to be looking to cut rates multiple times. And I would just say too that this goes back to we could be repeating the mistake the market made at the end of last year and the beginning of this year. You know, last October, Powell at the press conference gave everybody the indication they're ready to cut rates. He didn't say that exactly, but that's how the market took it. And over the next couple of months, the market priced in 7 rate cuts for 2024. And we got a huge move in REITs and everything that was interest rate sensitive. And it all started to fall apart in the spring because suddenly we didn't need 7 rate cuts. Now we're down to 1. So we need to be careful here. We need to think very carefully about what you want to do, particularly in bonds and anything interest rate sensitive, because rates may not come down as much as you think they will or as much as the market thinks. So that's our message for the week: is be careful. Be careful out there, because we don't know if rates are really going to take off on the downside here. I think people are really lining up and expecting a big bond market rally. I think they're going to be disappointed.
So if you have questions, be sure to send them to us and put them in the comments section down below.